We start today's show with concerning data out this week on the US economy. This is on top of all the things that we've already covered over the last week or two. And unfortunately, there isn't enough time to wait for the jobless claims coming out today because it takes so long to make the videos, do the research, record, edit, and get it uploaded. So we won't have that data. But what we do have is the manufacturing data. We have a lot of other things which some might be a little complex, but I'll break it down into simple language. Now, before we go on to manufacturing, which will be the main data point we're going to look at today, we've just had data come out on business collapses in the USA, which are now 73% higher than they were in 2020 at the peak of the lockdowns when a lot of businesses began to collapse. So the US is seeing a lot of business closures, and you don't need to wait for the media or the news to tell you this. If you go into your local shopping mall, shopping center, you walk around the shops that you used to go to, you'll see that a lot of them are closed. It's not just the USA, it's all around the Western world. We're seeing businesses that are shuttered and they're being replaced by new entrepreneurs going in some cases, but not all, which is pretty much typical of what you might expect when you go into periods like we have been. Similar happened in the 2008 crisis, similar happened in the 2000 dot-com bubble. But what makes this one a little bit different is that these new entrepreneurs that have gone in were not anticipating these huge increases in base level costs on businesses. So even the new ones that have been going in have been collapsing in the last 2 to 3 years. So this is quite dire for the US economy, but it's not the biggest data point. The main one we're going to start with today then is US manufacturing is actually in the biggest slump in the last 3 years. The manufacturing PMI is below the 50 threshold for the first time since 2009 as well. Anyone remember what happened in 2008? Yeah, it just happened to be the great financial crisis, one of the biggest crashes we've seen. And now with these rising interest rates, and we're starting to hear about growing recession fears. Even though we've been in a recession for a long time, they just won't admit it. Even all the data shows it, the charts shows it, everything shows that we've been in a recession for a long time, but the current administration doesn't want to admit it. Again, it's really damaging at them. Again, I'm not a political person. I don't get involved with Republicans, Democrats, or Labour Conservative in the UK or anything else. Try and be quite neutral. So I try to save my criticism equally for any party that's in power. But the current administration is really damaging the US on a massive scale, especially on a global scale. We've just had this as well come out from a meeting that's going on right now between Saudi Arabia and Iran. There's a lot of other meetings going on as well. And I just want to read out the statement they said at this meeting. There's a lot to go over. Unfortunately, time is against us today. So I'm not going to be able to cover everything, but I'll try and get a lot of it on the walk and talk tomorrow. But what they've said was the era, and I quote, "The era of the United States involvement in this region is over. The regional countries are capable of preserving security and stability in the Middle East without Washington's interference." So what they're talking about there is that the US proxy in the Middle East, which is of course Saudi Arabia, is now no longer, I think is the best way to say it. And in fact, we're seeing a lot of instability breaking out in the Middle East region as well. We've just seen fresh conflict in the last couple of days in the Israeli region as well. I won't get into all of that, but you know what's going on there. But the main issue for the US right now and what everyone's concerned about is these rising interest rates are now starting to weigh on businesses. Now, the media talks about this point a lot, but they don't actually explain why this is a problem for businesses. Well, there's a lot of things, but one thing for you to just think about is that when interest rates rise, banks become a lot more choosy on who they lend money to. The requirements to borrow money often are a lot more difficult as well. So if you are a business and you're looking for loans, it makes it a lot harder to get financing. And those businesses that do get financing, it's going to be at a higher rate than it was before. Now, the businesses have already got all of these new fresh costs, a lot of which they can't pass on to customers because maybe they don't have a moat. They're not the Coca-Cola of the world, or the Apple, or something like that, where they have a moat. Again, this is from my stock market course. If you remember how I told you how to pick these different stocks that will survive, we've got a story on McDonald's here as well, which the analysts have got completely wrong. They're saying that McDonald's is laying off staff at the headquarters and all this because they're in this big problem period. This is incorrect. Anyone who sells their McDonald's stock is going to make a big mistake based on this information. What happens, in fact, we will cover that now before going through this. What happens is companies periodically, they look at their staffing, they look at their costs and overheads, and then they start to cut those costs where they have excess or no requirement. This increases profitability within a company. This is just common sense. So by making layoffs in staff, why a lot of analysts think this is going to affect the stock price in a negative way, I'm not sure, because staff are costs on the overheads. So this brings down those costs, thereby making the company more profitable. And remember when I did the video about the last recession, and I did it in the private community, and I explained all about companies that tend to do well in recessionary periods, companies that don't do well in recessionary periods, what you tend to see is that people who like eating out, for example, in nicer restaurants, well, as their budgets get squeezed, they have to go elsewhere. And places like McDonald's, who sell, well, it used to be cheap food, it's not quite as cheap anymore, or some of these other cheaper fast food restaurants, or, you know, these dollar stores and everything else like this, their business tends to grow, or if it doesn't grow, it tends to stay sort of stagnant through recessionary periods. Because if you like to go out and for leisure, and you like to go out for food and things like that, are you simply just going to stop eating out, or are you going to bite the bullet and go somewhere that may be cheaper? And I'm not saying this is happening just yet, but it will happen later on for some families. And I'll prove this to you because we've got some charts that I need to show you, which again, the media are completely missing these charts, and they still think the economy is strong because they're not paying close attention to the debt levels, the credit card levels, the loan levels, and they're not paying attention to the savings rate, which are now inverted. But we'll come back to all of this in a moment. And by the way, if you're not following some of the stuff I'm talking about, remember, in the private community, I do a monthly macro video. It's 1 hour long, sometimes longer. It goes into detail on everything. There's tutorials on everything. There's spreadsheets with all of my investments, and there's allocation examples for you. You don't need to go and, you know, I keep getting these comments all the time, or these messages. Neil, I went to see a financial advisor. And again, I'm not saying all financial advisors are this way. Some of you who watch the channel are very good. But the general consensus is, Neil, I went to see a financial advisor and they are completely asleep. They said that there's no problem with the banks. They said that there's no problem with any of this. Go all in on the stock market now while it's been down, and all these other things, because they're just not awake. They don't understand what's going on. All they do is look at the mainstream media, which says everything's great, and they make their assessments based on that. So just be very careful whose advice you take. I'm not giving advice, this is just for entertainment purposes, of course, but be very careful with whose advice you take. And remember, I have a stock market course as well below in the description. But let me just bring you on to the ISM Manufacturing Index. So this is also known as the Purchasing Managers Index, or the PMI. You might have heard about that before. And I want to just take you onto the shared screen a moment here. This will be better for those of you visual learners. So here we have the FRED. So this is the PPI index, or the Producer Price Index. So remember, we have a CPI, we have a PPI, and then we have a PMI and all sorts of others. But I just want to show you the PPI here a moment, because this does feed into the CPI. So we look at this. Here's the 90s period. It goes up, we're in a recession. Here's the 2000. It climbs up, it goes down into a recession. Here's the 2008. It was climbing up through the recession, and then it dropped down. And then we go to 2020. It went down through the recession. Here we are in 2022 of June, where it climbed up dramatically, and now it's dropping precipitously. Now you just look at these patterns again. Do you notice anything about these patterns here? Do Do you not think that maybe they're trying to fake the data that we are not in a recession? It's obvious to me. You only have to look at this data to see we are in a deep recession. They just don't want to admit it. We can also look at the personal savings rate here. And I've taken this back to 2008 because where we are at the moment, this is the lowest rate, where it dropped down to 2.7 here. Even at 4.6, you have to go back a long way to the previous recession to get even close to this rate of 4.6. And look at what happened to the savings rate. It was extremely high with all the stimulus. And then we had the second stimulus, again, very high savings rate, but people just burned through it because that's what you were encouraged to do, spend through all of the savings. Now we have this low savings rate, which has been dropping in accordance with inflation. Now, let's just look at the average credit card balance. They are up 13% to almost $6,000. It's actually more than that now, but we don't have the 2023 data yet. So you can see 13% is a huge climb. The savings rate has dropped. We also have a higher delinquency rate. This is credit cards delinquency rate, and this is across all commercial banks. We also have the ISM purchasing index, which is dropping. All of these forecasts for what's going to happen at the Fed meeting, they are absolutely terrible. Don't look at any of these forecasts, and people pay huge amounts of money for all of this data to guess what's going to happen at the next meeting. The next FOMC is actually in 27 days from now, and I wouldn't bet the farm on what you're being told about this drop in interest rates that they say are coming, because I personally do not see it. And we're hearing this a lot at the moment, that they're going to drop interest rates at the next meeting. We'll come on to that in a moment. But we've got a fifth straight month of contraction in factory activity as companies continue to slow outputs to better match demand. Now, key word here is demand. Why? Because that was the Fed's plan, remember. Rising interest rate destroys demand. But what happened and why it didn't work the way they thought was because they didn't expect people to put so much on debt on credit cards and burning through the savings rate that they have. But they have burned through it now. So you should now see the demand, which is what we've seen the fifth straight month. That aligns with the forecast that I've made, that others made. It does make sense. But we've seen falls in all of these things. New orders, employment, backlog of orders, inventories, supplier deliveries, price pressure, all of these things have dropped. But we have even more data of all of this. We've got several freight companies collapsing. And what do they say? The reason is energy costs skyrocketing. There's been a lot of lobbying to the current administration to open up the energy supply. Energy is too expensive for companies and industry, which just wasn't listened to. There is rapid inflation, which the Fed pretends to be fighting when they're really not. You see, as I mentioned yesterday, they're in between a rock and a hard place. There isn't really a lot they can do about this inflation at the moment, because if they raise interest rates too much or raise interest rates too much, they're going to collapse the economy and the stock market. If they lower them, which is what people are starting to expect, we're going to see this lowering coming up soon, then all of this weakening demand that they have caused could start to reverse, and you're going to see inflation pushing up more. Now, the other thing that I covered yesterday was around the OPEC Plus cutting their output, whereas Biden asked them to increase it, so they did the opposite, they cut it. Now, this will also play into inflation. And I've actually, I'm kind of on the fence with how that's going to go. I made some notes on that. Okay, here's my notes. If Biden ramps up US energy, then I don't think we're going to see some big inflationary pressures from the cut in oil. But I don't think he's going to do it because he doesn't want to lose face with this whole green plan under the UN and the WEF and all this other stuff. He likes to look good at these meetings and say, you know, look what I've done. I've cut all the US energy, but I'm importing it from other countries. It's the same net benefit. Crazy. But anyway, so what you'll see is higher gas prices at the pump because of the lower supply, and he can only release so much more from the strategic petroleum reserve, which I just don't think he's going to. I mean, if he does, he's an absolute fool. If he releases even more than there is in the minute, 40-year low. But at the same time, the cut in oil prices could have some deflationary effect to it as well, which sounds strange, but let me tell you why. People who travel for work and income and things like that, it's going to be inflationary because they haven't got a choice. They've got to put the fuel into their vehicle. But people who travel for leisure, or younger people that want to do road trips and stuff like that, well, maybe they don't have as much money and they can't do the same amount of miles and stuff like that because the fuel is so much more. So that could be deflationary in nature from a leisure point of view. So that's why I'm on the fence with it at the moment. Most likely it's going to be inflationary in nature, and it depends if any more oil or energy is output, which I don't see. But this is the other reason I don't think that Powell can drop rates too much, because it's going to feed into even more inflation. It really is a difficult challenge right now, and I just don't know what the solution is for the USA. This is not going to end well. We've also got a lot more bankruptcies in the trucking industry. We've got, there's a lot of these trucking companies that are now filing Chapter 11 bankruptcy. Again, they're blaming it on all of these new measures, energy prices, and a huge amount of lots and lots of new challenges and fuel costs, as well as not being able to service the vehicles. There's problems with parts, new vehicles are too expensive, etc. There's a lot going on right now. So this company just closed. That's 22 tractors, 42 drivers, and there's a lot of these companies at the moment. We've also got in California a lot of warehouses closing down, and we're seeing jobs are a lot harder to come by in the state. We've got private payroll data, a lot worse off right now. US private employment rose by 145,000 jobs last month, compared with economists' predictions of an increase of 200,000 jobs. And we keep getting the same statement all the time. Market expectations have shifted in favor of the US central bank hitting the brakes on its interest rate hikes. We've also got other statements here about some analysts think they're now going to reverse, so it could be a 25 basis point reversal at the next meeting. We've had one guy, I don't know what he's smoking, he thinks they could go down by 75 basis points. Let me just say, they're not going to go down by 75 basis points or 1% or anything like that. It would be too steep of a drop whilst they're trying to fight inflation at the moment. We've also had a report out about fake job data as well. So a lot of the advertisers are putting up job adverts but then leaving them up. This is really bizarre. Some of the I've never heard of this before. Nearly half of hiring managers said they left job openings up to give the impression the firm was growing. 25% leave up job adverts simply to make the company look good. This is only in the USA would you see this sort of stuff. In terms of jobs then, Walmart is cutting thousands of jobs. Air Tours cutting thousands of jobs. Virgin Orbit has just collapsed, so that's all of those jobs gone. The Red Cross, 1,500 jobs. Amazon cutting more jobs. McDonald's we talked about. Apple cutting jobs. IBM cutting jobs. This is all going on right now in the USA. Are you hearing about all of this negative data? Probably not. And then some of the banks that we talked about before. So just in terms of banking, we've got Western Alliance, TD Bank, Peer Bank Canada. We've got a lot of these banks at the moment. There's some problems on the horizon. So WAL, the stock is 11% lower at the moment. We've got TD Bank Group, that's down 15.7%. Peer Bank Canada is down 15.8% as well. Analysts now think that commercial real estate is only worth 77 cents on the dollar. Sorry, those are the loans on commercial real estate. The initial forecast for this year was a 10 to 20% drop in commercial property prices, but now that has been revised to 20 to 25%. So if you're in commercial real estate, you might want to just have a look at your position there and see if you want to get ahead of the curve on this, if these statistics are correct, or if you have REITs, etc. This just goes on and on and on and on and on, my friends. It's not looking positive, let me just say that. And actually there was a lot more that I wanted to cover today, but I thought what I'll do is I'll group it all up into the US economy and where I'm seeing all these problems and weak points. And obviously I collect all of this data every day and put it all together for you. But there's a lot of other things that have happened today and yesterday, which I'm going to have to try and cover on tomorrow's Walk and Talk. So I think I'll leave it there today, but I will see you for the Walk and Talk tomorrow. It's going to be a good one. Take care. God bless. See you then.